Welcome, everyone. We will be rolling here in a minute. We just want to give everybody the chance to load in. We've got a great crowd joining us this afternoon, so thank you. Thank you also to those of you who joined us yesterday for the conversation with Congressman Steve Cohen. He is, of course, on the House Transportation Infrastructure Committee, so a crucial advocate in our efforts to get the bridge back in action sooner than later. So the Chamber has developed a multi-pronged strategy. We're aggressively ensuring that TDOT prioritizes this with the urgency that's required. So appreciate everybody for weighing in on that yesterday. That was a really important first step. So thank you. Let's just give a few more minutes here. Oh, good. Yeah, folks are really loading in. Also, if you guys, I think you may have just received earlier today your invitation to the Chairman's Circle Brain Trust. So that is going to be one, lots of fun, and two, informative, but surely a terrific chance to reconnect. It's been so long since we had the chance to give you a fist bump or a hug, even if you're willing. So we'll look forward to that very much. All right, I think we've got enough folks here signed on. It is my privilege to turn the mic over to Ben Adams. Ben is Chairman Emeritus at Baker Donelson and is the Chairman of the Chairman's Circle. I really am so grateful for your leadership, Ben. You're just the right man for the job. So thank you, and over to you.
Thanks so much, Nancy, and good afternoon, everybody. And what a great privilege it is to have this discussion today about the U.S. economy and monetary policy with Jim Bullard, President and CEO of the Federal Reserve Bank of St. Louis. And what unusual times we have now to hear from such a distinguished expert. President Bullard is a participant on the Federal Reserve's Federal Open Market Committee, which meets regularly to set the direction of U.S. monetary policy. He also oversees the Federal Reserve's 8th District, including activities at the St. Louis headquarters and its branches in Little Rock, Louisville, and Memphis. A noted economist and policymaker, Jim makes Fed transparency and dialogue a priority on the international and national stage as well as on Main Street. Also joining us today are fellow Chairman Circle investors, Brian Jordan, President and CEO of First Horizon, and Kathy Buckman Gibson, President and CEO of KBG Technologies. Brian is the Fed's 8th District Federal Advisory Council representative, and Kathy is chair of the Memphis branch of Board of Directors of the Memphis branch of the Federal Reserve. Brian will offer commentary on the Memphis market after Jim's comments, and then after Jim and Brian have spoken, Kathy will moderate your questions. As you think of questions, please type them in the Q&A field. We'd like to welcome members of the national media who've joined us today, and you should all know that Bloomberg is streaming this webinar live. So let's begin with President Bullard. Jim, the floor is yours. Thank you.
Well, thanks very much, Ben, and thanks to everyone for coming today. I appreciate the opportunity to be here. I wish I could be there in person, but maybe we're not too far away from having that opportunity and get back to Memphis and visit all of you. I titled this The U.S. Economy Booming. I don't think that'll be news to anybody on this call. We're getting many reports from across the 8th District on how fast the economy is growing. I'm going to try to characterize that for you in this talk. So let's go to the next slide and the next slide. So the key themes here are that the pandemic intensity continues to moderate in the US and Europe. I've got a chart that we'll look at on that. And so I think the health crisis is going to continue to wane in the months ahead. The US economy in GDP terms is poised to surpass the previous peak in real gross domestic product. So I'll talk about that. So that would be the end of the recovery and the beginning of the expansion that's going on right now. The fiscal policy, which I'm calling the keep household's whole fiscal strategy has been successful well beyond initial hopes. I've got some charts on that. Then we'll talk a little bit about the labor market in the US. I know this has been an important issue for many of you on this call. And I think I've got a metric as how we can think about the unemployment situation right now. There are a lot of unemployed people, but there are also a lot of vacancies. So we'll look at this metric, and that one's suggesting an exceptionally strong labor market in the current situation. For inflation, I think we'll see inflation meaningfully above 2% over the forecast horizon. I'll talk about that. We've, of course, we're still in a crisis. We've still got downside risk, but it's becoming less pronounced than it once was. So let's go to the next slide here, and the next slide. So I like to start with the pandemic itself because that's driving most of the policy considerations. Daily fatalities per 100,000 population have continued to decline in both Europe and the US. Asia, East Asia, and the Pacific countries are reporting daily fatalities that are much smaller order of magnitude, less, even 2 orders of magnitude less than those in US and Europe. So something very different is going on in East Asia and Pacific. You do have some emerging market countries that are still vulnerable and are on the upswing with regard to the pandemic. India is one that is, been on the upswing recently. But overall, I would say the regions where most of the global output is produced appear poised to bring the pandemic under control, and that's driving a lot of the pricing in financial markets. So let's go to the next slide here. This is the chart I like to use, and I've used it over the last 9 or 12 months to keep track of where we are in the pandemic. And let me just talk through this a little bit. This goes back to March of last year, all the way up to the present. The blue line is the US, the gold line is Europe, defined as France, Germany, Italy, Spain, and the UK. This is deaths, daily deaths per 100,000 population. The horizontal lines are just to give you an idea of some of the other leading causes of death in the US in 2018, and I just put those in as horizontal lines. So you've got cancer deaths in there as the blue dotted horizontal line, heart disease deaths as a gold dotted horizontal line, and accidental injury deaths as the lower gray line there that you can see. So that gives you an idea that the COVID deaths have sometimes been above and sometimes been below these lines. So it has at times been one of the leading causes of death in both the US and Europe. I think the other things about this chart are that we've circled the data at the end here. So this is when the vaccines got introduced, 60 or 90 days ago. That has worked well both in Europe and the US and has brought daily fatalities per 100,000 down to a low level, but not quite below the accidental injury line there. I'd like to see it go below that. It's about a 1.5 per day per million line there. So the run rate is a little bit higher than that for COVID right now for both the US and Europe. India, if they were on this chart, would be at about a 0.3 on the very right-hand side of this chart, but they're on the upswing instead of on the downswing. So I think the vaccination strategy is working and looks like it'll continue to work and continue to drive this all the way down, hopefully all the way down to zero. That green line at the very bottom, you can barely read it here. That's East Asia and Pacific. They just haven't had the same numbers no matter how you cut it. And so something else is going on in that part of the world. But if you think that's going to continue there and US and Europe are recovering, then you've got the major production centers in the world all hopefully putting this behind us in the months and quarters ahead. Let's go to the next slide. Because of measurement issues, another metric of pandemic intensity is deaths in excess of those that would be expected to occur in a normal year, the so-called excess deaths measure. You may have encountered this in previous presentations about the pandemic. For the US, excess fatalities are approaching zero. So that also suggests and corroborates the previous data that the vaccination strategy is bringing the pandemic under control. So let's look at that picture. That's this picture here. This is CDC data. This goes back to January of 2020 up to the present over on the right-hand side. And you can see this is weekly data. We've got a higher estimate, the blue line, and a lower estimate, the gold line. So at times you did have, lots of weekly deaths due to COVID that were in excess of normal deaths that would occur in the economy or in the society anyway. But now those have come down to zero on the right-hand part of this chart. That data can get revised a little bit, so we'll have to keep an eye on this. But if it stays at zero, then that would be an indicator that the pandemic is coming under very close control here. So let's go to the next slide. So let's talk about how the U.S. is moving into the economic expansion phase. The U.S. economy is not in recession today. It's not really even in the recovery phase. We're actually into the expansion phase, and that's because of some of the high growth rates that we're seeing right now. So business cycles have a clear traditional definition. The periods of declining output are called recessions. The periods of increasing output after the recession are called recoveries until you get to the previous peak in output. And then beyond the previous peak, we're in an expansion. So we're just moving into the expansion phase here. That's almost certainly going to occur during the current quarter. So like right now. And so this means that national income is as high as it has ever been and is poised to grow at an above trend rate in the remainder of this year and into 2022 and even beyond that. And that's due in part to the Keep Households Whole fiscal strategy, which I have some slides on here in just a minute. So let's go to the next slide. So this shows real GDP going back to January 2017. The recession was will probably eventually be dated by the NBR dating committee as February, March, April of last year. That's the gray area in this graph. Then you had the recovery phase, the green phase here, up until the current quarter. They actually do it by month, so it's not clear exactly what month this will occur in, but the recovery will end this quarter, and then we'll be into the expansion phase, the dotted blue line over there on the right-hand part of this chart. This is according to forecasts that are in the Wall Street Journal Economic Survey average. So you're going to reach the previous peak in output there at the end of the green shaded region. And not only that, this dotted line is going to go up, continue to go up at a rapid pace, and you'll actually get back to the previous trend line. If you drew a trend line, with your eyes here from 2017 to 2019, if you drew a trend line out, we're actually going to get back to that trend line and surpass that. So that is something that didn't even happen the last time we had a big recession. So this is quite the expansion and quite the pace of growth for the U.S. economy. Let's go to the next slide. The part of this is due to the fiscal policy response, I think also supported by monetary policy, but let's just talk about the fiscal response here. The first CARES Act and related legislation was about 3.1 plus trillion. The December 27th Act was another 900 billion. And the American Rescue Plan on March 11th was another 1.9 trillion. So these are quite large numbers, and this has had a big impact on the economy. Let's go to the next slide. The nature of the response was to the pandemic shock has been to ask some workers in the high physical contact jobs to stay home to invest in national health. The goal of fiscal policy has been to ensure these disrupted households by borrowing funds on international markets and using the funds to replace disrupted household incomes. We wanted people to be able to pay their bills and pay their rents so that we wouldn't do damage to the economy as we were trying to fight the pandemic. So I've called this Keep the Households Whole policy. And this policy has been so successful that personal income in 2020 was actually higher than it would have been if the economy had simply remained on the 2019 trend line. Personal income is the income that households actually have in real terms after getting transfers. Let's go to the next slide. So this is a picture that summarizes what the Keep Households Whole policy would be and where we actually are. This goes back to 2019, and these the blue line is the household income, the real disposable income of the households across the economy. And we certainly recognize that this is uneven across the economy, but we're trying to summarize this at a macroeconomic level here. The blue, and then this gold dotted line is what if you had just remained on the trend line? That is kind of an indicator of what would have happened if there had been no pandemic at all. You'd be on the gold dotted line somehow, or pretty close to that. So the goal of fiscal policy was to keep households to be able to pay their bills, keep them on the gold line. And you can see that the blue line is quite a ways above the gold line here. And you've got some forecasts from IHS Markit here, the red dots going forward. So it looks like we're going to stay above the gold line well into the future here. But the current value is several $1 trillion in inflation adjusted dollars above the gold line. So we've really got a lot of resources available at the household level. And that's what's driving the really fast growth in the US economy right now. So we've done a lot with this policy. I think we did keep households whole on average across the whole economy. And this has been very successful. Let's go to the next slide. A lot of households saved their transfers. This was a rational and prudent response as households were naturally unsure how long the health crisis would go on. And they were also unsure whether Congress would appropriate more funds. We got the arrival of vaccines much sooner than was originally anticipated. And that's meant that the probability of the health crisis ending in the coming months has risen very substantially, as we saw in the earlier data. So I think this means that the households are going to be less inclined to save going forward, more inclined to spend any federal transfers. And that's going to lead to very rapid US real GDP growth in 2021. The Atlanta Fed GDP now, I believe today is saying 11.5% real GDP growth at an annual rate in the second quarter. So that gives you the kind of idea about the numbers we're talking about here. That's much faster than even a fast growing economy like China. Let's go to the next slide. Let's turn to the US labor market. I just want to talk about this a little bit because it's been in the news. Real GDP is poised to return to and surpass the previous peak level, but the labor input remains below the previous peak by many measures. So if you look at something like total hours worked on an index basis, that's at about 96% of the pre-pandemic level. So a good question is, how can real output be all the way recovered? We are already back at the same level of output, the same level of national income that you had before the pandemic began, but the labor input is still down 4%. How can this be? Well, part of this is composition effects for sure. The most disrupted workers have been in the so-called high physical contact type jobs. Those also tend to be the lower wage jobs. And as we just saw, we're also trying to make sure that this Keep Households Whole policy is ensuring many of these households before they get back to, are able to get back to work here. Let's go to the next slide. So this is a picture of what I just talked about. The gold line here is real GDP again. It went down during the recession. Now it's bounced back and recovered to the pre-pandemic level almost, and is poised to go much higher. The blue line is hours worked. That's still down 4%. Let's go to the next slide. But I think, and you might think, labor markets are tighter than that graph seems to indicate. Certainly anecdotal reports from around this district and across the country strongly suggest that attracting workers to available jobs is difficult. So are there some alternative measures of labor market performance that might tell us, give us a clearer picture of how tight the labor market is? And I think there's two of them. One is the ratio of officially unemployed workers to job openings. This is one that's used in the academic literature, the unemployment to vacancy ratio. That measure is approaching an all-time low, suggesting a very strong labor market. So let's look at that picture. So this is number of unemployed persons per job opening. We're at about a 1.2 on the far right part of this chart here. So that's almost 1 for 1. For every unemployed worker, there's a job opening. That's one of the lowest ratios in the past 2 decades. If you look at this chart, which goes all the way back to 2000, when this data was first started to be gathered, you could see that during the 2000s, we never got down to this level. And we only had this good of a labor market in the very late years of the last expansion, 2017, 2018. So this would suggest that the labor market is very tight and would be consistent with all your anecdotes that you've been telling me about how tight the labor market is. So this might be a better measure in the current situation. Let's go to the next slide. There are also broader measures of labor market performance, and there are many of them, 15, 16, 17, 18 of them. So what you can do is take all those different measures and put them together into one index, a so-called indicator of labor market performance that would take all different aspects of labor market performance into account. The Kansas City Fed is kind enough to do this for us. They provide an activity index that is organizes this data into one number that we can look at. And this indicator also suggests that today's labor market conditions are markedly better than those following the 2007 to 2009 recession. So let's go take a look at that one. So here's the Kansas City Fed's labor market conditions index. This goes back to 2006. You can see the big recession in 2007 and 2009, and then a very slow climb out of that as labor market conditions. The index was a -2, then it climbed all the way back to a +1. Then on the right-hand part of this chart, the index falls again because of the pandemic, but it's already recovered all the way up to 0 and is in positive territory. 0 would kind of be considered normal labor market conditions. So this also would tell you that labor markets are much tighter than looking at the raw numbers would suggest. So 2 different metrics that are maybe more consistent with the anecdotal reports that we're getting. Let's go to the next slide. And the next slide. So inflation expectations are moving higher. Those of you that have seen me present before know that I like to look at market-based measures of inflation expectations. TIPS-based break-even inflation is based on CPI inflation measures. They've moved up a lot, as we're going to see in this chart. They're probably consistent with a personal consumption expenditures inflation measure, which is above the 2% target. The Fed likes to look at the so-called PCE inflation, which tends to run a little bit lower than the consumer price index inflation. So I'm going to adjust for that by just subtracting 30 basis points from the CPI based measure to get to a PCE based measure. So the FOMC is trying to raise inflation and inflation expectations. We've missed inflation to the low side of our inflation target for a decade. That's really not too credible of a policy. We're supposed to hit the inflation target on average. So we're trying to make up for that a little bit by allowing a little bit more inflation. So we're going to let some of this inflationary shock flow through to inflation expectations and cement inflation expectations at the 2% target. Let's go to the next slide. This is the TIPS-based measure of, so TIPS is Treasury Inflation Protected Securities. This gives you a real-time market-based inflation measure, expected inflation measure. What's good about this is that the markets are taking all developments into account, including Fed policy. They're incorporating all relevant information when they're trying to make an assessment of inflation over the next 2 years, which would be the gray line here, over the next 5 years, which is the gold line, and over the 5 years after that, which is the blue line. The Fed has a 2% inflation target, which is the horizontal green dotted line in this picture. And you can see that since Chair Powell's Jackson Hole speech, the vertical red line there, inflation expectations have been rising in tandem with the recovery in the U.S. economy, and now the expansion in the U.S. economy. And these inflation measures have all moved up over 2%. And I've already subtracted 30 basis points off here in this picture. So this is really a PCE. What does the market think the Fed's preferred inflation measure will be over these various horizons? And the answer is all three of these horizons, it's over 2%. So I would take that as some success for the Fed's policy of trying to get inflation above target for some time. And the market is incorporating that right now. At the same time, I would not say that these are so high that they're worrisome, and markets do take everything into account. So I think these are in pretty good shape right now. They're indicating PC inflation above target over these horizons, which is what the Fed is looking for. Let's go to the next slide. And the next slide. So pandemic intensity continues to moderate in the US and Europe in particular. I think the vaccine strategy is working. We've still got some risk, but it's becoming less pronounced. US economy is going into an expansion phase, partly because the fiscal policy has been so aggressive and the Keep Households Whole policy has been so successful, well beyond the initial hopes for that policy. I think the anecdotal reports on tight labor markets are corroborated by the measure of unemployed to vacancies. That's approaching an all-time low. Also, the labor market conditions index is looking very good. So those are both suggesting a strong labor market, which is different from what you get from a raw count of hours or a raw count of jobs. Like inflation, accordingly, is likely to be meaningfully above 2% over the forecast horizon. So I'll stop there. And I'm looking forward to a discussion with the group here. So thanks for having me today.
Thank you, Jim. Really remarkable insights. We appreciate you sharing them both with our Chairman Circle investors as well as the members of the media who joined us today. Just to note, those of you who joined us a bit late, we are streaming live on Bloomberg, which is sort of atypical for the Chairman Circle. I want to make sure you guys are aware of that. Also want to remind all of you, please type your questions into the Q&A field on Zoom. We are going to now hear from Brian Jordan, offering some commentary on the Memphis market. Brian is President and Chief Executive Officer of First Horizon National Corporation, and as Ben shared, he represents our districts on the Federal Reserve's Federal Advisory Council. Brian is a Chairman Circle investor and is a great friend of the chamber. Brian?
Thank you, Nancy. Good afternoon, everybody. Thank you for having me. I've got to acknowledge Jim Bullard and the St. Louis Federal Reserve Bank. They have an outstanding research department, and Jim has been tremendously influential as monetary policy has unfolded over the last 10 or 12 years that he's been leading the Fed. He's had me working for him for most of those years, so I've learned a lot from him. I would pick up where Jim left off. I think this is a very strong expansion that we are seeing. Jim talked about the effectiveness of the monetary policy that the Fed employed, as well as the fiscal policy that Congress employed. Jim focused on the consumer, and I think he's right on target. En masse, the consumer is in a very strong position. They have more cash today than they had a year ago. If you look at average balances, and in many ways, they've benefited from not traveling or taking trips and spending some of the outflow because they've been confined to home. So the consumer starts off in a very strong place. I think the other element of fiscal policy that worked very well was the PPP program. It did a very good job of keeping people connected to jobs, and it kept employers in place. And I know when I talk about consumers and employees, there have been extremes in all cases, and some people are worse off than they were a year ago, and some employers are no longer there. But in mass, Jim describes it as the keep people whole policy. I think effectively the fiscal policy enacted by the two administrations now, as well as the U.S. Congress, has done a very good job of nationalizing the economic cost of the shutdown, and we ought to be positioned for a very strong recovery. If you look here more specifically in Memphis, you're starting to see tremendous number of job openings open up in hotel and services, warehousing and distribution, healthcare. So we're seeing tremendous number of job openings and demand from employers. We're starting to see strength in the construction markets, particularly as it relates to warehousing. There are some impacts that are emerging as it relates to supply chains, and I'll touch on that again in a minute. But we're seeing that warehousing can be very strong. Office in particular is a little bit softer. That's probably a reflection of a number of things, one of which is probably an acceleration in the way people work, more remote work, and the ability to work from home. We are likely to see residential housing continue to strengthen and improve over the foreseeable future. Construction costs have gone up, lumber and material costs have gone up substantially, but the housing market has been strong, and therefore the mortgage market has been strong as well. Companies like Allsack and St. Jude and their commitments to expand in Memphis will be additive to the economy. FedEx and the influence of having the world's largest cargo airport will also be very additive to the strength of the Memphis economy. When you talk to commercial architects, you get a strong sense that there is a very strong backlog of activity in the marketplace, and that demand for services is going to be strong. It will be interesting to see what, if any, impact the I-40 bridge will have. Nancy mentioned that in her earlier comments, but clearly the I-40 corridor is a key corridor in crossing the river across the United States. The I-55 or the old bridge will take the load there. But right now the river is stopped until they can determine whether the bridge is stable enough for barges to go under. So it'll be interesting to see what impact the I-40 bridge, the new bridge, the 50-year-old new bridge, has in terms of the economic impact, not only here in Memphis, but also in the broader center part of the country. So with that, Kathy, I will stop and turn it over to you, and like Jim, I'm more than anxious to get into question and answer.
Thank you, Brian, and thank you, Jim. Appreciate your comments and for being with the Chairman's Circle today. We had several questions that were submitted ahead of time, as well as a number in the chat, but I wanted to start off with one, Jim, that I think has made the news over the last several days, and that is as it relates to unemployment benefits and your comments around the labor market. Several states, including Tennessee and I think Mississippi and Alabama in this region, have decided that they're not going to continue to accept the enhanced unemployment benefits from the federal government. And how do you think that's going to impact our labor market and the metrics that you talked about earlier?
Yeah, I think it's a little bit early to expect these high physical contact workers to be coming back to their jobs quite as fast as I think markets were thinking. The pandemic isn't quite over. I think there's residual worry about the pandemic. Not everybody's vaccinated yet. You got a ways to go on that. And I think the unemployment insurance top off is disincentivizing people. So on the margin, I do think it is an issue. I think you've also got the childcare issue with and various school districts are in different states, and so if you've got kids at home, that really changes your calculus about whether it's time to go back to work or not. These workers are in fluid markets where they can likely wait another month and still there would be a job that they could go to. So I think all of those things are coming together to kind of create this situation where you can't find a worker. It seems like you should be able to, but you can't find a worker. But I think that will all dissipate in the months ahead as we get further along on the vaccines and some of these issues get resolved. I'd expect to see very strong labor market reports through the summer.
Okay. We had a question submitted by David Waddell, who is president and CEO of Waddell and Associates and a member of our Chairman's Circle. He'd like to hear your thoughts on the current monetary policy that has focused more attention on deficits and wonders whether Congress should instead be using inflation as the metric to inform tax and spend policies.
Well, I think one thing about this era is that all these things are way off the scale about what we're used to. The deficits used to be $100 or a couple $100 billion. Now you're talking trillions, and monetary policy. We've got rates at extremely low levels and lots of bond purchases and so on. So. I think that we are in unprecedented times, and it is very unusual. But I would also stress the pandemic itself is a very unusual situation. And if there was ever a time when you're going to have these kinds of policies, maybe now is the right time. I think it's certainly looking like now that we made a lot of good calls during the pandemic. We got the vaccines going, which came online much sooner than anticipated. We kept the households and as Brian mentioned, the PPP program to the extent we could. We kept businesses hanging on to get through the pandemic, and then and that's going to pay really good dividends as we come out, because we didn't do as much damage to the economy as could have been done. This could have been a very different scenario where things spiraled downward, and that's what people were worried about at the beginning. But now it's looking like we're going to get out in fairly good shape. You never want to go through a pandemic, but we're going to get out in fairly good shape. So, I don't know if this is being useful to the questioner here, but I just wanted to reiterate that I do think that despite our dysfunctional politics in the country, I do think we hit on a good policy for this particular pandemic.
We've had a couple questions come in from listeners today. Mike Derby and Sue Stevenson kind of had similar questions, and that is, with the strength of the economy and the tight labor markets and increasing inflation expectations, is it time for the Fed to make a move in terms of its interest rate policy, or to pull back on buying bonds, or to kind of shift its current position?
Yeah, I think monetary policy is in a good position today. I do think that we'd like to get to sort of the end of the pandemic, whatever that officially means. But you'd like to get a little further out of the tunnel here and get a little more reassurance that we really have come to a conclusion on the pandemic, at least in the US. I think for the rest of the world, it's maybe going to take another year. Some vaccinations are slower, and you've got other issues in other countries. But for the US, it looks like we're getting closer and closer to the end of the pandemic. But when you're in a crisis, I think you don't really want to change policy while you're still in the crisis. You really want to make sure that you're getting out of it. We did get a good announcement this afternoon, CDC relaxing some of its restrictions. So that kind of thing I would take as a harbinger of more and more information that suggests we're bringing this under better and better control. People will get more confidence that they can go back to more normal activities. And that certainly sounds like a recipe for a very strong growth in the US economy in the coming quarters.
So part of that strength that you mentioned in your comments, it goes to the housing market. And John Webb, who's the market president for our Tri-South region from Cigna, asked the question about what do you really feel is driving this boom in the housing market, and is it sustainable into the foreseeable future?
Yeah, I think one of the problems in any crisis is that you tend to fight the last war. And you remember the last war. And I think when we came into the pandemic, the natural thought was that the housing market would not do well, it would collapse, and you'd have that would be a problem on top of the pandemic. That actually did not occur. The kind of one of the twists in the crisis was that the housing market actually looked good. People liked their houses. They wanted to upgrade them while they had to sit at home. They wanted to buy new houses. So build new houses. So the housing market has turned out to be a bright spot, not a negative spot during the crisis. So this has gone in the opposite direction. And I see, with our low rates and the strong demand and shifting demand also, I think people also didn't want to let, you have to be careful here. They're not wanting to live in apartment buildings as much as they did previously. They're moving out of more congested cities out to more suburban type areas. So it's not that every segment of the housing market is doing beautifully, but what we usually think of as single family homes in suburban areas, that's doing very well. So I expect this to continue. And, it looks like a very strong housing market going forward. The problem may be actually supply constraints of various kinds, which are pushing up prices in certain areas, or just making it not possible to do some things at any price. So that's also seems to be happening in certain areas.
Yeah. Katie Schatz, who is the CEO and executive vice president of the Memphis Association of Realtors, also has a question related to housing. And it gets into, the fact that the Fed, with its cash injection last spring, it really helped lower interest rates for borrowers. And even though you don't have direct influence on mortgage rates, it did have that impact. And so her question is in the future, do you see any concerted effort on the part of the Fed to create sort of that symbiotic relationship between the Fed rates and mortgage rates? Or is this just an anomaly that we ended up with in light of the unprecedented events?
Well, there was, when the crisis came upon us in the March, April timeframe last year, financial stress measures were at 2008 levels. We have a financial stress index at the St. Louis Fed. It was close to the 2008 level. So the possibility that you would go into financial crisis on top of the pandemic was very tangible and very real. And the Fed worked, and I give a lot of credit to Jay Powell on this, very closely with the US Treasury. We revived some of the programs that we used in 2008. We brought other programs online. And I think the mere fact that we set those up so rapidly actually reassured markets and drove financial stress down to low levels. So again, this was something that could have gone very badly, and certainly we expected it to maybe not be as good as it turned out. But financial stress went down, and actually markets started to do very well, and so we actually got that part of the crisis to come out pretty well. Part of that was the Fed doing the sorts of quantitative easing that we did during the previous crisis, which we're still doing today. And as I said, I don't think you really want to change policy while you're still in the crisis, it's still in the pandemic tunnel. But that has certainly lowered the longer term yields, and we did have a rise in yields a little bit earlier this year, but it's capped out below 2%. So another factor here for those in the mortgage markets is just that the international situation is for extremely low rates around the world. So when the U.S. rates start to get even 160 or 180 or 2, that's very attractive compared to what you can get in Europe or Japan. So that's acting also as a cap on where U.S. yields can go.
Thank you. And I think we all appreciate the quick response that the Fed took when the pandemic hit last spring. A lot of credit to you and everyone at the Fed for taking decisive, quick action. And I think we all agree it certainly has helped ease the impacts of this pandemic on our economy. So thank you for that. In that vein, and I think you've already answered this question, but I'm going to go ahead and pose it because it's been posed by a couple people in the Q&A, and that is, with the strength of the housing market, why is the Fed continuing to buy mortgage-backed securities, and is it time to put that to the side?
Yeah, I mean, there's just no question that the housing market is very strong, at least in the way I described it earlier. And I think it's too early to talk about taper because the pandemic is still going on. We can see the end of the tunnel, but we're not out of the tunnel yet. And once we get out, then I think it'll be time to visit what we should do with policy, and that's certainly one of the things that we can look at is the mortgage-backed purchases.
Okay, so I'm going to ask you also, Jim, in light of what's happened to the I-40 Hernando de Soto Bridge here in Memphis and Arkansas, your thoughts on what impact that might have. It is a main thoroughfare for a lot of our over-the-road traffic throughout the country, including the Mid-South, and just your thoughts in terms of what impact that might have.
Yeah, I mean, I'm learning about it as we go along here. I've read some things on it. You guys are more informed than I am, but frankly, I'm a little concerned here. This is both the highway aspect, but then especially the river aspect seem pretty concerning to me, and I'm not sure how fast this can be remedied. And so this is pretty concerning. That's a lot of traffic that is being held up here. It reminds me of the Suez Canal situation. So I hope we're not in something like that. But I know it's developing and it's moving fast, and I know you guys are on top of it.
So thanks. I just ask if there's any other questions to please put them in the Q&A. We are coming to a close with our session with Jim and Brian, but I appreciate the time that you've spent with us today, and all the questions you have answered. It's the data that you provide and the analysis associated with that is always refreshing and informative, and I think that we can all be hopeful based on the data that you did provide today in terms of where we are with the pandemic, as well as the economic recovery, and not just recovery, but expansion. So if we can just find the workers to help us continue that, we'd all be a lot happier. Because again, as you said, we all, I think, anecdotally are seeing it, experiencing it, and it has the biggest challenge I think that many of us are facing right now. So I don't see any other questions. And so I am going to thank you again for being with us. And I am going to send this back to Nancy Coffey, who is the Senior Vice President with the Chamber and in charge of the Chairman's Circle for us.
Thank you, Kathy. Stay up for just a moment. Put yourselves on mute though, so I'm not, thank you. You know, Brian, I wondered if you might have sort of one remaining question for Mr. Bullard. Anything you think we need to ask him to kind of put a punctuation mark on this?
Well, this is, you know, the question that in my mind, and I think I'm in the camp of the FOMC when it comes to inflation, and these forces ought to be transitory, especially with the demographic numbers that we have in the US and the productivity gains that we've even seen thus far in the recovery, now expansion. You know, the question I would leave Jim with is this, is how will the Fed make a determination between transitory inflation and something that is more problematic or more permanent down the road? And when do you start to make those judgments?
Yeah, Brian, it's a great question. And the answer is very carefully. We will. I think it's going to be a tough call here. Some of this is transitory, but not all of it. And we have to somehow separate the wheat from the chaff here. And you know, it is a time when the data is a lot more volatile than what we're used to. We've had this very tame inflation data for quite a while. Now you've got many things going on in many different corners of the economy. You've got this explosive growth. So I think it's going to be it's going to have to be a judgment call. There's no question that there are these one-time increases in certain commodities, certain products, and certain corners of the market. And then you've got the new Fed policy where we are trying to take some of it on. We're trying to get inflation to be a little bit higher, you know, above target for some time. So all of this is something that the committee's judgment will have to decide. But I do think, myself aside, I think my colleagues are very strong analysts and have a long history of watching the U.S. economy. So I do think that collectively we'll have a good judgment about this and be able to discern the permanent from the temporary component of inflation. So it's a great question. It's probably not a great answer, but that's where we are right now.
All right, well, thank you. Thank you to you, Jim, for your remarks today, and of course, for the quick action the Fed took in the midst of the pandemic. Of course, Brian and Kathy, for your leadership here in Memphis. We are so grateful, and for your involvement today. A few brief important announcements. Next week, Economic Development Officer Ted Townsend is going to be meeting in small groups with Chairman Circle investors to do really a deep dive into the Chamber's new economic development strategy. So space is limited, but if you haven't signed up, please do reach out to Project Manager Lisa Lovell. She will get you hooked into one of those small sessions. As I mentioned at the start, June 15th, 3:30, Chairman Circle Brain Trust event. We will be in person at the FedEx Event Center at Shelby Farms. I'm so looking forward to connecting with all of you there. We will be hearing from Ted there about how we're going to position Memphis to win. So, for example, next time Oracle is on the hunt for a new place to land, we will be at the top of the list. And then June 22nd, this is going to be really interesting. 3 o'clock, our mid-year Chairman's Forum. It's going to be virtual. We're featuring Bruce Katz. So Katz is a globally recognized economic expert. He's the co-author of The New Localism, and he really elevates this idea of innovation districts in urban centers as a key driver to sort of shape an economic recovery that's more inclusive. And the best part is he has identified Memphis as a high potential target city for piloting this innovation district concept. So we're really pleased that we are right on his radar, and I hope that you will join us for that. Look for an invite soon. Thank you to all the Chairman Circle investors who joined us. It's just a delight to have you on with us, and we will see you soon, June 15th. Be well. Thanks, everyone.